understand the behavior behind investing, and also bring the voice of a traditional finance perspective, okay? So welcome to Crypto Mondays, you guys. Raise your hand if this is your first time here. Nice, welcome, welcome, welcome. So just to tell you a little bit about the Blockchain Center, I am Erica Gemma. I'm the CEO here. And how many of you guys have seen the Netflix documentary, Banking on Bitcoin? Very good, guys. So it's actually the only documentary on Netflix about Bitcoin. If you watch that documentary, you'll learn about the Bitcoin Center Miami, which is kind of where we came from. And we decided to open up the Blockchain Center. This center is a co-working office and event space. We do a lot of educational events, and our goal here is to make Miami the best educated city in the world when it comes to this technology, because we really have an opportunity here, you guys. Miami is already the Silicon Valley of Latin America, and because of that, you have every city in the world right now vying to become the next tech hub. We have an opportunity here to become that next tech hub as our world increasingly moves online. So we hope that you guys stay connected. If you guys need office space, event space, or if you have any events that you want to host, please let myself know, let Maria, our wonderful bartender, know back there, Matthew, who is running the front desk, and then Scott. Oh, right there. If you guys have any questions, please reach out to us. Also, if you guys are traveling from Broward here, we do have reduced parking for people who need validation. And then also afterwards, how many of you guys have been to Lost Boy before? Cool. So what the Blockchain Center is part of is we're part of revitalizing downtown, right? There's this whole plan for downtown Miami to become just this place for millennials, right? And we have we're kind of at ground zero right now, so we have a lot of room to grow. So we like to support the other businesses on Flagler Street, so they support us as well. After this, if you go over to the Lost Boy, which we tend to do as a group, they'll give you half-off drinks, and we can continue networking there. So without further ado, I am going to introduce our speaker for the night. Come on up. I think he can give himself a better introduction, but we met on LinkedIn. And we just met up, started talking about Bitcoin and cryptocurrencies, and I mean, we love people here who are passionate, and they're good teachers, and he fits all the boxes. So, Jorge, please introduce yourself, and enjoy, you guys.
Oh, thank you. Well, I'm sure if you all are here is because you've heard that you can make a lot of money in cryptocurrency, right? And you're going to put $1,000 and you're going to multiply it to go to $1 million, 1,000x. And you probably are expecting you're going to get some hot tip from me to get into that kind of money, right? Well, I got a news for you. I don't think I have that kind of tip. But what we're going to talk about today is making sure that you get a good framework about how to think about this, investing in cryptocurrency, digital assets, and more importantly, that you don't lose all the money that you put in. Because let's face it, this is almost like the wild, wild west of investing. It's still not sure what the regulations are. People don't even know how to trade it. And it's, we need to first get educated about investing and what happens when we as humans invest. So as Erica was mentioning, I'm a real financial advisor. I've been over 10 years working at the Lubitz Financial Group, working with clients, also overseeing all the investment strategies, spend a lot of time thinking about how to allocate money for clients. And this is where, this is one of the areas that I've been exploring and thinking about. So, to start off, probably don't necessarily, if you want to read more about me, you can go online. I mean, all the information is there. You probably want to start hearing more about what we're going to talk. So why this is important to get all this knowledge before you start investing. I believe it's a great time to be an investor. I mean, just recently, a few weeks ago, we had the major institutions, Schwab, Fidelity, TD Ameritrade, saying, we're going to give you trading that is free for you. mean, you could trade every day now, stocks and exchange-traded funds, and not pay a commission. I mean, that's unbelievable. That's great for all of us. Technology is giving us access to all kinds of investments that before was not possible. You now have the ability to do all these cool crowdsourcing platforms and invest in real estate and invest in all kinds of things with other people, and technology is enabling that. I think digital currencies, cryptocurrency, it's no different. This is enabling a totally new area to invest, and we just need to learn how to do that. The challenge is there's not a lot of education around it, and just financial literacy, it's very low. And unless you seek it out on yourself, it's tough to come by. So to make matters worse, there's something going on with us that, we're just not wired to think about money. If you think about it, our brain is still the same that it was thousands of years ago, before we had to exchange money, and we had markets with lots of participants. And when you start adding all those layers into it, our brain is probably not the best suited to make investment decisions. So then we get something that is referred to as the behavior gap. Essentially, this means that generally investors don't make the same amount of money that the investments that they put the money in. That's what is referred to as a behavior gap. Very simple way to illustrate it here. It's just been studied year after year after year, and it doesn't matter what year it is, whether it's an economic boom or it's a recession, this still shows up. And it's here to tell us that sometimes our biggest enemy to make money in the markets or in any kind of investing, it's us. So maybe we need to spend some time learning about how to tame the beast, and learn how to create a process and a framework to avoid that. So to explain a little bit that behavior gap, here's a chart from JP Morgan to show you. And this is the last 20 years. And for those in the back that may not be able to read, what the chart illustrates is the last 20 years of different types of investments, and shows you the return that those investments made. So for example, publicly traded real estate, great investment, 10% annualized year over year for 20 years. That's pretty good. Stock market, as defined as the S&P 500, 5.5%. Some people think it's always higher, and historically, it's generally being a little bit higher. But look at the very far right. The average investor annualized return is about 2%. How's that possible? I mean, that's a huge difference. I mean, if you just put the money in some investment that buys the S&P 500, you will have done more than twice the return. So something's going on here. Now, you may think, well, how this applies to crypto or digital assets? Well, the truth is, we have no data. I mean, the way these studies have been done is by gathering information from custodians, financial institutions, trading patterns. We just don't have that data yet. But if we look at the rationale or the reasoning that explains why that behavior gap happens, it's most of the times all around our emotions getting in the way of our decisions or our investment actions and our trades. So I strongly believe that there is a behavior gap in cryptocurrency or in digital asset investing. That is here to stay, because this, until everybody is putting money into this, is going to be volatile, meaning you're going to have wild swings on the upside and you're going to have wild swings on the downside. And when people see their value drop 20% on a day, it happens, people panic. So I don't think, it will take a little time for us to find out the evidence, but chances are there is a huge behavior gap. And that's dangerous, because people then think that they're going to get all these astronomical returns, but the reality of it, maybe not a lot of people get that because they react along the way, they panic along the way. They sell at the wrong time, so they sell low when they're panicking, and then they buy when everybody is getting back in. Why I think this is gonna happen? Because that's kind of what the cycles of innovation and bubbles have occurred. If you look at this chart, it's essentially trying to show you how the cycles of financial bubbles are created and how they get, you get through self-destruction and the emotional ride that you have along the way. If you try to plot this to the price of Bitcoin, it's kind of similar if you think about it. We've had the last boom or bubble, as people were saying, 2007, huge gains and huge crashes. We go back 3-4 years, we had the same. And if we go even further back, we have similar experience. So chances are, we may have another of these cycles again. I don't know if it's gonna be as wild as the ones before, but possibly we may have another one. So, and the problem with crypto is that it's not like the stock market that goes up, it goes up a year 20%. Now, 2 weeks ago, Bitcoin jumped 20% in a day. I mean, it's crazy. And when something like this moves so fast, your brain just hijacks your rationality around it, unless you have some rules and some framework to think about this. Because when you go the ride up, and you're riding up the wave there, and all that you think about is greed, it's just when you're in Bitcoin, it just feels that everything goes to the moon, right? I mean, you've seen all these memes. The problem is when you also, that's when everybody's jumping in. When you start getting your grandmother saying, I want to buy Bitcoin. True fact, okay? But when things go down, how does it feel? It's super hard. I mean, you're looking at 80% drop in the value of the things for like a few months. And then the only thing that remains is people that really are holding for their dear life. I mean, if you put it in perspective, this is what you're seeing. These are the so-called bubbles. These are the so-called busts. Every time you've had more than 80% drop. For somebody that sells when it's 70% down, it's catastrophic. It's almost permanent loss of your money. So if you don't put some guardrails on this and you make sure that you can sleep at night when something like this happens, chances are you'll make a mistake and it was gonna cost you a lot of money. Hopefully not, after today. Another challenge with that, let's say you try to time things. When I saw this chart, I was blown away. There is a lot of studies done in stock market investing about what happens if you try to time the market and you miss the best days of the market. In Bitcoin, it's even worse. This chart shows you that if you take out the 10 best days of Bitcoin every year, the return that you would have gotten is actually negative 25%. I mean, that's just so wild. Like, this is just you one day, you overreacted, and all of a sudden, you're not getting the gains. You're not enjoying the ride up. So, super important to make sure you have the right mindset when you're getting into this type of asset class or type of investment. So what can we learn about behavioral finance and behavioral economics? There's been a lot of study, a lot of research about it, and maybe this can help us be a little bit more rational, if that's possible, when thinking about money. So they've done a lot of studies, and they've hooked a lot of people with in the CT scans, and they try to look at how brain activity changes when they put you through some stock market competition that is fictitious, to try to study how our brain reacts when we're thinking about making investment decisions. So then they compare it to the normal brain, which is kind of a normal state. And then found out that when you're thinking about stocks, your brain looks more like this. I mean, jokes aside, the truth of the matter is, when you are high on an emotional state, you're not rational. You tend to think more in patterns. You don't think through things. You overreact. When you are euphoric, you tend to make, like, for example, when you bought Bitcoin and all your friends are saying, yo, you need to buy more Bitcoin, and the greed cycle comes in, and you feel overconfident, and you want to buy more, and you're starting taking money out from places because you want to buy more, or the reverse. These things happen when we start getting emotions in the way of making decisions. So this field of study of behavioral economics has looked at all the behavioral biases that we have, and they've identified over 100 of them. We're not going to go through all of them, just saying. But this gives you an idea that we have a lot of ways that we're just misbehaving. We're not behaving rationally as the originally economists thought about. We are humans, and when you put markets together, which is a collection of human beings, sometimes we make irrational decisions. So one thing that really helped me is I picked up this book a while ago, Behavioral Investor, and Daniel Crosby actually, I suggest if you want to read more about it, he presents a very good framework to take all these 100 different biases and actually put them in a more kind of easy to digest buckets. So I'm going to use his framework. I thought it was really useful. He put majority of the biases are around ego, conservatism, attention, and emotion. So I'm going to touch just on the main ones. So ego biases, very clearly, the biggest one of them being overconfident about things. So this happens, and it's actually self-reinforcing, because if you go to the doctor, even if you go to a financial advisor, you're expecting that advisor to know everything that you're going to ask them. And the truth of the matter is, sometimes we just don't know. But we're many times forced to be in a position of telling you everything that we know, when in reality, some things are just beyond our control. So this is one of the areas that, in this book, Daniel Kahneman, he actually won the Nobel Prize of economics about all his work. He says this is probably the worst and the most dangerous behavioral biases of all. Because when we feel overconfident, and that happens often, we just don't care about the risks. And we put all the risks away. And we don't spend the time to think, what if? Or let me take another perspective. We don't stop and think about that. And then we start really thinking that everything is riskless. We're going to walk in the park just like any other day when,
Hello.
Thank you. Maybe it's so how overconfidence could apply to cryptocurrency? It actually could apply to any type of stock market investing. I mean, you can look at every year how many analyst forecasts you see in the news saying, oh yeah, the market is going to do this. The market is going to end, the S&P 500 is going to finish at this level by the end of the year. Do you ever look back and see what actually happens? The results are pretty much almost like a coin toss. It's crazy. But, they feel like these are
Right. Man, I missed I wanted to hear about the Bitcoin halving.
More to that later. Confirmation bias is another big bias that we have. And this is actually something about our beliefs, and whatever we think is true, we're gonna try to find data points outside in our environment or from other people that actually confirm what we believe. If you think about it, if we put it in context, our brain tries to go through shortcuts. So one of the easiest shortcuts is not have to think hard about what you hear. And you're gonna try, unconsciously, you're gonna try to validate what your thinking is and what your beliefs are. So this is one of the major problems, because you just try to confirm all the things that you have or how you see the world, and you don't take the time. Generally, people don't take the time to learn about the opposite opinion or the other side, and to question the things that they believe. It just takes time. It's hard work. So maybe we should do a little bit more of that. Every time you want to make an investment decision, think about taking the other side. What if you're wrong? What's the worst that could happen? Who will take the other side of the trade? Other area of biases, conservatism. So a few of these actually were explained very well in this book by Richard Thaler, also another Nobel Prize of economics. Endowment effect, it's a powerful one, I think, and essentially it goes like this. You tend to stick to the things that you already own for much longer than you perhaps should. And you don't question why you own them or why you have them. Same thing happens if you created something or if you built something. So this is very common in, for example, people that work in publicly traded companies, and they get stock options. And they get these and they feel endowed to them. They get this, they just stick with them, even though they don't question whether it's the right thing to do, to stick to to keep all those stock options or to keep so much of them. So here's a book if you want to read more about it. Another of these biases is the power of defaults. I really like this one because it's really, really powerful. In the book, The Means Behaving, actually, you could read about how organ donations population changes dramatically in different countries. Oh, there, okay. Thank you. Organ donations, as the willingness to donate organs changes dramatically just because in the form of your driver license is an opt-in versus an opt-out. Guess what people choose? Whatever the default is. So if the default is opt-in, you're gonna be an organ donor, or 80% of the population is. I mean, this is really powerful. So for example, somebody was asking me about Gemini as a cryptocurrency exchange. If Gemini is the only cryptocurrency exchange that you use, they only have about 5 different coins or tokens. So the default for you, if that's all you use, is to access those 5. But what about the rest? There are over 1,500 or so cryptocurrency. What about the rest? Maybe you don't need any more. That's a different argument, but that's the default you will get. So think about the defaults that you're getting into and maybe question them. Familiarity bias is another powerful one, and essentially says that we tend to stick to the things that are familiar to us. This could be investments, so you're gonna tend to have investments that you know about or you hear about or your friends have. And it may be a little scarier to do things like cryptocurrency, like, who does that? Because nobody around you does it. So, try to take a worldwide view of that. And on that comment, one of the most common familiarity bias that exists is the home bias that people investing in the stock market have. And this shows statistics about the world market capitalization. The US is about half of that. So about half of the world stock market capitalization is in the US. But US investors generally have about 80% of their stock holdings in the US. Now you may say, well, it's the largest economy, and yeah, I'll take it, but go to Canada, go to UK, go to Australia, go to Japan. Same thing happens. I mean, Canada and Australia, look at that, the statistics. Their share of the world stock market capitalization, it's like 3-4%, and they have like 50-60% of their stock holdings in their country. So this is truly familiarity bias and home bias, and best example. Another one that is a problem, anchoring and sunk costs. I mean, have you made an investment that you purchased it, let's say at, I don't know, $80 or at whatever price you purchased it, and then it fell in price, and then you just kept holding on to it just because you strongly believe it's going to go back to whatever price you purchased it at. Or you're going to say, yeah, I'm just going to wait until it goes $10 above what I purchased it at. I mean, we all have done it. And the problem with that too is that we suffer from sunk cost, in the sense that the more effort we make or we take to make that decision, the more likely we're going to stick with it for longer time without questioning why. So think about your holdings, your investments, or anything that you own every time, and question, why do you own it? And if you wouldn't redo your portfolio, your investments, and own the same things that you own today, then maybe you need to get rid of something. Attention biases, another big one. The biggest one there is recency bias, meaning that we tend to believe that things that happened in the recent past are going to happen again. Bitcoin halving is a great one, and I have an example here. So here's a chart about what happened to the Bitcoin price over the prior halving events. So one, we'll say, well, it's probably going to do the same thing again, because the last 2 or 3 times has done that, right? Well, have you really questioned that? Why is it that it's going to do that? Is it supply and demand purely, or what is it? Give it some thought. I mean, here, the truth is we only have 3 prior events, so we cannot go back prior to history and question it, are there other circumstances? But, think about it. If you truly believe that it's going to happen, question it why. Not just because it happened last time. Availability heuristics. So this is saying that things that are in top of mind, we believe they're going to happen. There's more likely to happen. So if I tell you, any type of risk that you have in your life or investing, chances are you put a higher probability of something happening if you've seen it recently, or that you've experienced it recently. And I have a crazy statistic here that we can think about probability of deaths. What do you think is more likely to die? You think it's more likely to die in a skateboard accident, in a shark attack, or in a selfie accident? Selfie accident. You already know that. But I mean, this is so wild when I was looking at this. But a lot of people that, think about a few years ago, not a lot of people were doing selfies. I mean, this data is from 2015, but I mean, everybody, especially here that we're close to an ocean, will say, oh yeah, shark attack is more likely you'll die from that. Well, again, it's availability in our heads. And then the other issue that we have now, especially in the information age, that everything is so accessible to us, we have so many choices. I spoke about the institutions like Schwab, Fidelity, commissions on trades now are 0. Now you have the world and the entire stock universe that you can trade for free. Well, how are you going to choose? Same thing with cryptocurrencies. There are over 1,500 of them. How are you going to choose? The problem with that is that the more choices we have, or the more options we have, sometimes it just leads us to do nothing. Because when we do nothing, if we get it wrong, it's okay. I just didn't make a decision. Well, the reality of it is you made a decision not to do anything. But if you make a decision and it's wrong, because there were so many options, you're going to regret it. So, and we fear regret. So, think about all these choices that you have. I mean, maybe how can you simplify or streamline all the things, all the different options that you have, so that you're not so overwhelmed by them? Emotion biases. Well, you know, when we already know when we are high on emotions, we're not as rational. I mean, we all will have gone through that, and market cycles are the best example of that. When things are going so well in the market and you're investing, that's when you feel the most confident. You feel like you've made the right decision, that you're doing great. But you know, it's tough to really know, is it your skill that you were really a good investor, or is it just luck because the entire market was going up? It's really tough. And the opposite is true. When markets collapse and markets go down, I mean, when Bitcoin is down 80, 90%, think about how discouraged you are, and you're just devastated, something you're just about to give up. But that's when the greatest potential lies for investing. It's kind of that contrarian approach. And it's really, really hard to do. Loss aversion, kind of straightforward. This essentially says that the pain that comes with any type of loss is greater than the gain that we get whenever something goes well. I mean, this has been studied in many different areas. I think it's straightforward. We just prefer not to lose more than we prefer to gain something. And mental accounting. I love this one because we all do this. We all have buckets of money. And depending on the label of the bucket that you put, you're willing to be riskier or make certain decisions, and others you're not. This is the same as, you know, you're more likely to spend frivolously a $1,000 bonus that you just got, as opposed to you going to go to buy a car and all of a sudden they tell you about a $1,000 rebate and you just spent $1,000 less. You're not gonna go to the most expensive restaurant in town to get a nice meal, but you might do that when you get a $1,000 bonus. At the end of the day, it's almost the same, it's the same amount of money, but we do that all the time. So use mental accounting to your benefit. Think about how you are bucketing or how you're labeling the different pockets of money that you have and what they should be doing, and use it to your advantage. So we've gone through a round of behavioral economics. So now you know a little bit more about how our brain is wired and how we think when we are trying to invest. So let's think about how to invest in cryptocurrency, how you should be thinking about it. This is relatively new, so it's not like you're gonna get a lot of people out there telling you how to invest. It's almost like you're gonna have to figure it out on your way. So I'm not saying that what I'm going to share with you, it's not necessarily the only approach, but I think it's an approach that is reasonable and I think would avoid you from a lot of sleepless nights when you have a crash of 80% in your holdings. So how you think about it through the lens of your income. So if you want to save and invest on a regular basis, generally speaking, we recommend, okay, you're going to have some money that is going to go to pay your rent, your living expenses, and all that stuff. You need to have some money that is devoted to emergency fund, some cushion, so that if you need something because you lost a job or because a health situation happens, you know where to go. This is the place where you go. It's not going to be your crypto holdings. It's not going to be your stock market holdings either. This is a place. So first, establish that. After that, then you can begin investing. And then you can begin thinking about, okay, do I put money in my 401k? Do I put money in other type of retirement account? Do I put money in any kind of short-term goals? Within that, then you can think about investing in cryptocurrency with a portion of it, depending on you want to be super risky with it or you're super convinced, but we'll get there. But just think about the different buckets of money again, but use it to your advantage here. If you want to devote some type of money every month for investing, it's after you set aside money to cover some emergencies, and from there, let's begin investing. So how should you think about investing in this new asset class, as we like to call it? So this new market, you're trying to put a portfolio together, you're beginning to invest. Should you put all your money in cryptocurrency? Yes. If you are strongly convinced about what's going to happen, then maybe. But I'm here to tell you, perhaps you want to take a different approach, and it actually may work out better. You could have cryptocurrency in it. It's just, let's create a framework around it, not just let's put all. Concentration, if you put all your eggs in one basket, can be a good thing if things go well. But concentration can be a bad thing if things go wrong. So think about a proper risk management approach. What are you willing to risk? And how convinced and how likely are you to suffer from overconfidence from this process, right? So let's go back to the bias and use it to your advantage. So first, let's try to put this in context. So if we're going to put a portfolio together, let's look at the investment universe. So where do we have here? We have maybe a little bit difficult to see, but it's color-coded, so it gives you an idea. Let's see if I could have here. So if you see here, this area on the top is your publicly traded stocks in the US, publicly traded bonds. All the red here is real estate, publicly traded. All down here in purple is private real estate, so people and institutions owning real estate. The entire investable universe, in a way, think about it as $440 trillion. Bitcoin is like a third of one square. So let's keep that in mind as you try to create an investment portfolio. What do you want to get access to? What kind of sources of return? What areas are going to do well in different market cycles? This gives you an idea of what the entire investment universe exists, and how do you want to allocate through it. So one thing that could be helpful in thinking about this is, what does the smart money do, right? Everybody wants to see what the smart people do, the smartest guys in the room. So perhaps looking at some of the largest endowments that manage billions of dollars may give us a clue of where this should fit in. So let's take a look at two of them. I'm not saying that this is the approach that you have to take to invest your money, but it's an approach that, hey, they've been doing this for many years and they're very successful at it. And they have the ability to hire the smartest people in the room. So the endowment of Harvard, the endowment of Yale, they have publicly traded stocks, publicly traded bonds, real estate, both public and private. They have natural resources, think about as timberland, think about as agriculture. They have trading strategies like hedge fund type of things, and they have private equity. And private equity being a pretty nice allocation. So are these institutions investing in crypto? Well, they're beginning to. So how are they thinking about this? So let's take example of two endowments that have allocated some money to this. So two pension funds in Virginia have recently put about $40 million into a blockchain fund. And this was all over the news because it was actually one of the very first large endowments to put some money into it. But I want to put a caveat here, because this fund that they've put the money in, and the majority of endowments, what they are doing is putting money in venture capital funds that are investing in companies that are trying to disrupt or grow the blockchain ecosystem. Generally, they are not putting the money into buying Ethereum or Ripple or as XRP. Some of them are putting money in Ripple as equity. So interesting distinction here, because they may provide funding to Coinbase because they're saying if the entire ecosystem grows, Coinbase as being one of the most prominent crypto exchanges in the world, they will make money for the fund. So different approach here, but they're beginning to allocate. And just as a reference, $40 million for this pension fund is about 0.5%. So keep that in mind. So what happens when you actually go through that process like an endowment went through and put some Bitcoin or some digital assets in a traditional portfolio of stocks and bonds. So there are actually, studies that are showing you this, what happens. And there are some interesting implications. This may be a little bit difficult to read, but essentially there are different scenarios here of a global stocks, 60%, 40% bonds. And when you say global stocks, is the entire world stock market. And then you have different scenarios, one with adding 1% Bitcoin, 3% Bitcoin, and 5% Bitcoin. You see the different results in the chart all the way down back from September 13 through June 2019. You could pretty much tell that the one that has 5% Bitcoin has had better returns. Obviously, it's been a great run for Bitcoin. What's interesting, though, is that if you look at the increase in volatility or the increase in risk as they measure it, it's actually not that much. But from a return perspective, you do get 5% Bitcoin adds about 5.5% increase annualized return from that time period. So from an institutional endowment that manages a lot of money, that increase is actually probably interesting to look at. Another example is, what if you, instead of just doing Bitcoin, you actually do like a portfolio of digital assets? So almost like taking an index approach. You say, I'm going to buy the largest digital currencies that exist. So carve out very small allocation, and then buy across all the top coins or digital currencies. What happens? So very similar result. Now, if we were to put the two charts side by side, the most interesting thing is the return is about the same, a little bit better increase, but the risk or standard deviation is a little less, having this diversified approach. And we'll talk a little bit more about why that is. So now we put this cryptocurrency world in perspective on how you want to think about investing. So what are strategies or tips that you can take away and apply to your own investing? Well, if we look at all the successful investors, one of the things that they have in common, all of them, is that they realize they cannot make decisions at the whim of the moment. They cannot be just winging this as they feel. They try to get emotion out of the equation, and they have a process. They create an investment thesis, they really define what their investment beliefs are, and they create some rules or some framework around it. And one thing that is very important that they do is that they stick to that framework. They're just not going to change their framework because last month something didn't work. Sometimes you're going to have periods that is not going to do well, but if you have a really good framework and rules-based system that has proven to work over time, the challenge is, well, digital assets have been around so little that it's tough to put a framework around it. But there are many principles that you can apply here that will work. So different ways you can think about investing, right? So you can be trading, you could be a trader. You could think about creating some algorithm or program that is going to buy and sell whatever digital asset that you want. And for traders, cryptocurrency is great because you have a lot of price movements up and down. So if you have a pretty good system that works, you probably have a lot of opportunities to make money out of it. The challenge here is there are lots of hedge funds or people with a lot of PhDs, programmers, trying to do exactly the same thing. Essentially, this means you're going to create probably a program, algorithm, that you're going to hook up to your machine and to some exchange, and you're going to have it being running trades pretty much 24/7. Because, hey, cryptocurrency markets don't close. So if you're able to generate just 0.5% or less every day or every week, and the markets don't close, and you could do it through different coins, then good for you. So anything that has to do with trading means that you don't care what the market does, really. You're just trying to take advantage of price movement through some rules-based mechanism. The biggest area here that has been exploited for centuries, I would say, is kind of following trends, right? That's where all the charting comes from, and that in the industry is called momentum. So it's essentially means that whatever the price trend is upwards is going to continue, and whenever the price trend is downwards is going to continue. So you can go long and you can go short. And nowadays, with the new derivatives products that are coming out with Bitcoin and Ethereum soon and all that, so you have more products or vehicles to actually put your opinion to a trade. This is where you need to get familiar with all this stuff, right? Trading, all the charts. Although, yeah, probably nowadays not so much is the computer program that is going to read them for you. What if you want to be more like an investor? And you want to take more of a long view. So you want to say, I'm not going to spend all my time doing all the computer programming. I'm not a programmer. I just really believe that this area is going to continue to be growing, and blockchain development is going to grow, and a lot of people are going to buy more Bitcoin or whatever other asset that you pick, Ethereum, whatever it is. Then you need to have some kind of methodology to provide, to value this, because the overall investment thesis will be you're going to buy when things are low and going to sell when things are high. But how do you do that for Bitcoin? How do you do that for these assets? There's not really an established foundation, right? So how are you going to do that? But the idea here is that you're going to hold on to your investment for a while. So biggest challenge here. How do you create a methodology for how much Bitcoin, in this example, is worth? I've scoured all the web, and I've read some studies, and I've read some white papers, and I've read some, Twitter forums, and all kinds of, you name it. At the end of the day, to be honest, I have no idea. This is really hard. Because what worked 2 years ago, it may not work anymore, because this area is developing so fast. It may not work the same way it was. Like, one of the models that I looked at is actually based on some models that were used to value networks. And Bitcoin is a network, but does it really apply? So then you're going to have to think about how this is going to drive price appreciation over time. And some things you can put in context and compare. So obviously, the more people adopt Bitcoin, the better, because it's a scarce asset, right? There's only 21 million Bitcoins that are ever going to be mined, so scarce, defined. And nobody can tamper with that, which is one of the benefits. You have a lot of millennials, you have a new generation adopting it, and they're conducting their lives online, and probably they're going to be more willing to embrace this technology. That's already happening. Network growth is continuing, and it's all-time highs, is strong, and I think that's just a mere reflection of a lot of different players and institutions coming into this space. I don't think that's going to change. And the more growth there is in a network, the more secure it becomes, because the harder it is to tamper anything that has to do with Bitcoin blockchains. One of the issues that is a challenge is the regulatory development. So just because there is no regulatory clarity, there may not be so much investment adoption. So, one attempt to this, because the guard, especially in the US, we don't have clarity. Some institutions have put together some ratings around cryptocurrency and tokens to try to come up with a way to establish whether one of these digital currencies or tokens are securities or whether they're not securities. After all, that's one of the major areas of regulation, is to determine whether these coins are a security or not. Obviously, the biggest challenge is we're using a regulation that was enacted like 80 years ago to apply to something that it was created just a decade ago or less. really challenging. But it's a framework that, the moment we have clarity around this, probably there's going to be a lot more investment in it. As an example, I use Bitcoin as we're rated here with the Crypto Rating Council, and XRP, so the token created by Ripple. Number 1 is the least likely to be considered as security, and a number 5 of the rating is the most likely to be considered as security. And the challenge here for Ripple is that if you look at all the language behind it, it has more security-like language in its documents, in its white paper, in their websites, and all that. Bitcoin is the least likely to be considered as security because, come on, US Congress is going to come and say, yeah, Satoshi Nakamoto come here to Congress and to testify? Yeah, not happening. So the moment we have more clarity there, I'm pretty sure there will be more adoption, there will be more investment in it. Some of the models I run across, comparing the Bitcoin network growth, similar to the value of the network or the amount of users in the network. This methodology has been used to value the growth or to project the growth of Facebook users, and also Tencent, which is kind of the Facebook version, but in China. Up until 2016-17, it's actually worked pretty well. But now it's not showing that it's projecting the price so well anymore. Because the challenge there is not every user has the same amount of Bitcoin. If users start having a lot of Bitcoin, it's kind of skews the numbers because all this is all based on number of wallet addresses, number of users, and transactions that happened. So another model that is coming to be popular, and you see it a lot in online, is this stock-to-flow model, and it's essentially taking a valuation methodology that has been used for gold and other hard assets or commodities that have been used in some kind of monetary examples, and it's basically saying that the more production that an asset has or a commodity has, it's the opposite one. The less production there is to the total supply, the more scarce it is, which means that the price should be higher. So if you think about it, it kind of makes sense. If gold all of a sudden has half the production per year and the demand continues to be the same, gold price should go up. So it's kind of the argument here for the halving event. That if you have the supply of Bitcoin decreasing and you have increasing demand, then you'll have the logic of the model says that you'll have price that will increase. Whether it holds true or not, we'll see. Another way that people have tried to come up with a price point here is what is the use case of Bitcoin? So is it trying to replace gold? So what if, in this case, is a hypothetical price if Bitcoin takes 10% of the entire gold market. In that case, here, all physical gold, if it takes 10% of all physical gold right now, the price of Bitcoin is projected to be $40,000. What if it becomes 10% of all the allocation to alternative investments that institutions have? Well, that shows it's about $36,000 will be the price of Bitcoin. What's the right answer here? Not sure. And this is really going to depend a lot on how everybody around the world adopts this and embraces it, and what their use cases and beliefs on using Bitcoin are. For people that have countries where they are confiscating their currency or they are devaluing the currency 20, 30% from one day to the next, you bet Bitcoin is going to be a great solution. And it's going to solve a real problem. For developed countries like US, Europe, maybe it's not so relevant, that use case. So what other use cases are we going to find for this? There could be many. So another way you could think about investing in cryptocurrency is trying to pick the winners. So in the investment world is trying to be an active investor, meaning you're going to scour all the white papers that exist and try to pick those tokens that are going to go 1,000x and are going to make you a crypto millionaire. So let's see how this works in the stock market, since we have more data, more years, and also think about it. A lot of these projects are companies, are like startup companies that are trying to put together a product or a service, and they're just created. It's a different governance model, different structure, but it's kind of similar. So what happens in the stock market when you try to pick the winners? Well, if you look, this is really fuzzy, but I'll try to explain. Since 1989, so let's say since 1990 through 2015, you have that about 80% of all stocks lost money, and just 20% of all stocks are the ones that created all the gains in the stock market. So here the question is, can you pick those 20% of stocks that created all the wealth in the last 30 years? How overconfident are you that you can do that? Let's go back farther in time. This is a research study that was conducted recently in 2017. And I'm going to read this for you because essentially the research paper says, do stocks outperform treasury bills? Treasury bills being the US T-bill, so the safest assets in the world pretty much. The highlight here is saying 58% of all stocks have lifetime holding period returns less than those on 1 month treasury bills. So he's saying 60% of all stocks since 1926 have made less money than holding T-bills. That's crazy. Now this is even worse. The entire net gain of the US stock market since 1926 is attributable to the best 4% of all stocks. So this is saying that the majority of the gains in the stock market since 1926 only come from 4% of those stocks. How can you pick those winners? It's extremely, extremely hard. You know, anyone gonna guess companies in the top 5 or top 10? Maybe? Amazon is there, Google is there, Microsoft is there. Number 1 is Exxon, because it's been around for so long and it's created so much wealth. Just, we all think about Google, Amazon, and Apple because that's our recency bias, right? Interestingly enough, Berkshire Hathaway, a company where Warren Buffett invests, is just outside the top 10. That actually surprised me. So, can we learn something from what the smart guys and then venture capital firms do in this, and how they approach risky investments? You know, that could be a way that we could learn how to invest in cryptocurrency, right? It's a risky asset, has high volatility, and a lot of moves. So one of the things that venture capital firms do is that they spread their investments across a number of companies, because they know going in that more than half or 2/3 of them are going to fail. And they're going to make money, and a lot of money, hopefully, in just 1 or 2. So the numbers work out to be something like this. If you take $1,000 and you spread it around 10 different companies at $100 each, and you have 3 of them that actually lost 100% of your money, and you have another 3 of them that you lose only half of it, another 2 or 3 that you lose just 20%, but you have just 1 that goes 1,000x on your money, you end up making 48% return. In the world of investing, 48% is awesome. Now, the key here is how many of those 1,000 returns can you get? And that's what's going to drive a lot of the numbers. So this could be, this could be an approach that if you want to invest in cryptocurrency and you want to spread your bets in a way because you're not sure, you're not overconfident about one project or another, this could be a way to think about it. Say, I'm going to spread your risk that way, and you hope that you'll get a big winner or a few of those big winners. Just a framework. Or you could use another approach, which is saying, I really know that this space and this blockchain industry is going to grow. I really believe Bitcoin is here to stay and it's going to be adopted, but I have no real clue about what other projects, tokens, coins are going to do. So you're going to be passive. In the investment world, that means that you're not going to try to read all the white papers and try to pick your winners and all that. You're just going to hold some subset of the market just like it's available. So you saw an example before of that kind of top five digital assets. So this could be a way you could do it. So there are actually funds that are beginning to do that. Bitwise is one fund that has been doing this for a while. They charge you in excess of 2% to do this. It's only available to rich people. But essentially, they're diversifying your money across the top 10 largest coins or cryptocurrencies. And they're going to rebalance around this, which means that every month or every quarter, they're going to look at the largest coins and they're going to change that allocation based on that weighting. If you don't want to if you don't have millions and you can invest a little bit, this is what Coinbase does. And now a lot of exchanges actually let you do this for you. You could buy a little allocation like this. So Coinbase has this. You can buy their index, and it's easy. And you have one of the 4 largest coins right there with one buy. I will argue that one challenge there is that you're not holding the actual keys of the coin. You're not having custody of them. So very different story. And then, another way you could think about it is, how do I access companies that are taking advantage of the blockchain industry? That's another way. Think about just publicly traded companies that are trying to invest in this space. It's just not going to be the same. Another thing that you could think about is, you could actually think about investing in cryptocurrency focusing on income. So obviously, everybody may have heard of mining. So you can make money mining, so giving computing power to create new blocks on the blockchain. That's more probably like a business, and from a tax perspective, that's income that is taxed, and you could make a business out of it. There are large mining pools that are essentially lots of people pulling resources together to do this. So it could be profitable. Just think about whether it's profitable at your small scale or not. Staking services is something new that is coming up because of the new model of governance in cryptocurrency of proof of stake, which essentially means that you're going to give your coins to the network or to a node and participate in the governance of that network or that cryptocurrency. And in exchange for doing that, they're going to give you some type of reward or tokens back. This is a website that lets you identify different coins that you can put in staking. The only thing I warn you is it may sound really fancy and great that you get 10% return for staking a coin, but if the coin is going to drop 90% in value, who cares? It really choose carefully on what you're going to do. The last area that I think is really interesting is decentralized finance. So these are new movement where essentially they're allowing. If you think about it, a lot of custodians and financial institutions make a lot of money from lending securities. So these institutions or these companies, what they're saying is, we're going to continue to lend the securities, in this case, our tokens or coins, and I'm going to kind of democratize this and pay back my users for allowing me to lend those coins. So here, BlockFi is one of the largest in this space. You can deposit the Bitcoins or Ethereum, and you're going to get 6.2% on your Bitcoin or 4.1% at the latest. So one way to earn some income while you're holding. Celsius is another of those applications, and actually what they're not just doing the lending on that, but some of these coins are actually staking coins. So these are coins like Dash that essentially they're doing all the hard work for you on staking. One thing I will warn though, this is very, very new field, and there is a lot of money exchanging hands here, and not really sure how counterparty risk is playing out. So if we have a meltdown of a lot of money leaving this space, who is owing what to whom, and what's going to happen? And I have no answer to that, so I just warn you, do your homework. Who is Celsius lending, or who is BlockFi lending, and how are they making sure they're not going to lose money to you if something happens? And where are your coins? Who's the custodian, right? I'll go through this very quickly. We touch upon diversification or trying to hold different assets. Even within crypto, there could be value of diversifying. You may not be able to read, but this is essentially top 10 crypto assets and the variability from month to month. It's a little old, but you get the point. You're gonna have different price behavior from the different coins, and just by holding different ones, you're gonna get diversification and, generally speaking, lower a little bit your risk. You also can think about different applications or use cases of the cryptocurrency world. So maybe you wanna make sure that you own companies or you own tokens that are going to solve a specific problem, like smart contracts, where also maybe you are very bullish on privacy tokens. So that's another area that you can focus on the different areas. And lastly, I'll go through this very quick. Not forget, at the end of the day, it's not only what you earn, it's also what you get to take and is left. There's not a lot of cost when it comes to trading in cryptocurrency. The exchanges have very minimal trading fees, but we have to pay taxes. And next year, actually, the IRS has put a little checkbox that everybody has to check when they have any type of cryptocurrency holding. So just be aware of short-term and long-term capital gains. It's a difference. Long-term capital gains could be 15% rate, but you have to hold the asset or the investment for 1 year. Tax loss harvesting could be a great strategy. If you have coins or tokens that have declined in value 50, 60%, and you want to offset gains that you've made with others, something that you could think about to offset gains on other investments, just be careful of what is called the wash sale rule, which means you cannot buy that same token or investment 30 days after. If you do, the IRS disallows that loss. So keep that in mind. Custody and private keys, super important. If you want to learn more about, sure, here at Bitcoin Center, you have classes around it, but super, super important, think about this. Who holds your assets? Who holds your coins? Is it an exchange? Is it a third-party custodian? Do you have your own wallet and your own keys? The safest, of course, is your self-custody, you have control of your keys, and make sure you keep them safe. Other solutions, obviously, third-party custodians. So for example, Celsius uses BitGo, and in case of BlockFi, I believe they use Gemini. So they are using custodians for holding your keys. Just know where those are. And one of the biggest challenges here, how are you gonna keep handling this asset in terms of estate planning or legacy? Who has access to your keys? What happens if something, you hit by the bus? Who has access to that? All these exchanges don't really have a mechanism yet to properly accommodate that. So if you have self-custody of your coins, then it might be a little easier. But if you don't, it could be a nightmare. And if you have a lot of money, your family may lose it, or your partner, or whomever. So, I may not have given you a hot tip to make 1,000x on a token or any coin, but I hope with what you learned today, you have a better framework to put some money to this exciting new technology that probably is here to stay and grow, and also make sure that you lose little money and make more money with these ideas. So with that, I can open up to questions, and obviously the big disclaimer there that everything I've said, it's not considered financial advice, it's also my opinion. Just ask your advisor. And I'll welcome any questions. If you hold an investment for longer than a year, then it's long-term capital gains. If you hold it for less than a year.
When is it 15%?
If you are in the 22% tax bracket, marginal bracket or above, it's 15%. If you're making no money, you could pay 0% capital gains. But I mean, most people that are have a job or have income are in the 15% tax bracket of capital gains.
Right, so in real estate, it's 20%.
Depends on your tax bracket.
So if your tax bracket is less than 20, then you pay 15.
If you have no other income and the gains that you make selling real estate don't push you to a higher tax bracket, you would pay 0% taxes on the gains. But it's all dependent on the tax bracket that you are in.
Other questions? Go ahead, Rob.
So, can you go into the IRS classification of crypto as separate asset class for next year? In particular, like, do a checkbox, like it's a checkbox for just crypto or a digital asset? And the second question is, like, how that actually classified as compared to other asset classes? Loss of crypto, stocks, which actually are a much lower.
Oh, bro, one at a time. One at a time.
Can
All right, first question.
can you repeat that first one?
All right, so it's just a scenario, like you're a miner,
Uh-huh.
you get income from your mine from your right? So then how do you classify that as income? Except now that you have like a bunch of Ether or Bitcoin, right? How do you classify that as capital gains? First you get income.
The The IRS has said that mining activities is considered income. So the mining, when you're generating new coins, right? So it's just it's almost like a business activity. So it's like you selling a product or a service. So if your mining activities are generating income for you, it's considered taxable income as if you have a business.
So I get $10 in Bitcoin and I pay $30, I pay $3 in taxes. Now I got like, I still got $10 Bitcoin left because I paid the taxes.
But you paid on the income that you made from the mining activity.
But I'm paying my taxes in cash, not in Bitcoin. So I got Bitcoin left.
Yeah.
Year two, and I got this. Now what do I do?
So year two, you've had your Bitcoin for more than a year, and your Bitcoin doubled in value, let's say, and you sell it, then you pay capital gain term. That you may want to ask for that tax CPA that help you with the rules, because the mining, it's being viewed as just a business activity. So you might as well create a business around it, and if you have expenses, which you will have on electricity and equipment, etc., then you could offset some of that income because that's a business activity.
Well, I was going to say, it's probably getting to the point you're basically getting double tax if you're doing this, because you're going to be paying your income tax on that as taxable income, and then you're going and selling that Bitcoin, which you've already been taxed on, you're going to get taxed again.
See, also, you said that, but like, I think what he's saying is like triple tax if it goes to separate asset class now. Right. You can't use those losses against stocks or something else. That's how it's classified.
If you're the best thing, if you're setting up mining operations, get a good CPA that can help you in setting up the most tax efficient way. To one of your questions about what if you have gains or losses. There are some that are beginning to become like experts on the area, and obviously there are not that many. But on your second question about what if you have gains on any kind of crypto asset or losses in this case, can you offset that with any other gains that you've had, let's say on buying stocks, and you can. Because the IRS has said, from an investment point of view, they're considering it as property. So property could be stocks, it could be bonds, it could be real estate, it could be another crypto asset. They're considering it as property.
So we have really great crypto CPAs that we can recommend if you guys need one. Hopefully you do.
There you go.
Into your making gains. Now, questions?
We
Alex?
will be bringing a CPA on later in the year to give specifics right before tax time.
What else?
Hi. So yeah, I mean, I'm a miner. I've been nevertheless, but I see now that with what you're talking about, the staking is where things are going, and it's a really great way of doing that without having to have equipment. All you do is stake the coins, you get paid for it, and it just becomes multiplies, and then you just keep staking, and it just becomes substantial. But one problem is that he's talking about is the custodial services, because you've got to send your coins, and then what
Right.
happens?
Yeah.
They go out of business. They're going
Yeah.
to coins.
It's a challenge.
Well, I know because I just do it on my own Linux server. I do it myself, so I stake my own coins. But for the average person, that's a big concern. I don't know. What do you think?
Yeah, I think honestly, if I look like years out, I see that the same way Airbnb is allowing people to make money out of unused space on your home, and over time, I think that you're not using your computer at night, or you're mining, but the average person is not, or your phone. I mean, it's very likely that we'll have services that will utilize unused computing power to do these type of mechanisms, computing, new blocks or staking or anything. I mean, it wasn't not that long ago that I think it was Huawei or a cell phone maker said they're gonna create a cell phone that will let you run a node of the Bitcoin Lightning Network on the phone. So, yeah. Yeah, so think about that. I mean, I think over time, especially if all the blockchain technology continues to grow, it's gonna take more computing power. But at the same time, there's a lot of unused computing power. Same thing for file storage, right? Like if you get a Dropbox account and you get 10 gigabytes, but you're only using one, well, is there a way to monetize that? Well, with blockchain, perhaps there is. I think that eventually we'll get there. It's just so early. And we don't have the easy to use user interfaces for the main, the lay person to do. So that's why, you need education also. Like, it's a paradigm shift completely.
So I have a kind of complicated question. What's interesting is that you have these traditional, very complicated financial trading instruments like futures trading, right? Now, what's interesting with futures trading is you actually don't need to hold the asset in order to be able to bet on it. And so traditionally, in the crypto market, people attribute the opening of futures trading with Bitcoin to the start of the crash, right? From almost 20K. Now, in a decentralized, first of all, why do these things even exist, right? Thank you. Why?
What, the futures contracts?
Yeah, futures contract. It's really, in my mindset, it's not fair that we are allowing people to bet on things that they're not even taking a personal risk in, right? So it's just this whole weird manipulated financial system. Now, whether you believe that's true or not, the question is there a way that we, as people who are well, this is a different asset class, it's a non-correlated asset class, can we say, okay, corporate America, okay, Wall Street, you're not allowed to do futures trading with our assets? Is that possible?
You could take that position, but I don't think it's going to happen because it's like I could bet on the price of coffee going up with a futures contract. I don't need to hold the asset. I mean, that has grown over time because people needed a way to hedge. Now, those financial instruments have grown as a way to provide risk management, as a provide also trading. It's profitable for all these institutions. And there are a lot of trading strategies that's all they do is trade futures contracts or trade derivatives. And they don't necessarily care. To talk about traders, all the quantitative based hedge funds, they may not care what the price of corn does, but they'll try to exploit that because of their models.
What is the word?
Yeah, it's at the end of the day, right?
Couldn't you do a self-directed Roth IRA or IRA retirement account style and do the trading within that? So you don't have to worry about the taxation aspect?
Yes.
To mitigate the tax
Yes.
risks?
Yes.
Nice. Good.
There are now there are some self-directed IRA custodians that are beginning to do that, to allow you to have call it a Bitcoin IRA, or there are different structures. It's just not, it's going to be a little bit more complex and it's going to cost you some money, but hey, if you have enough money in the account and you want to do it, sure. Nowadays it's possible.
It's planned now, before the next run, so during,
Yeah, I mean, you can totally do it now. You can totally do it now. Now there.
I wasn't, it wasn't actually a question, I was just going to comment on the prior question about, you know, kind of with the phones and technologies. I think like being in the space, we kind of forget how early on we are. But I mean, there's definitely other methods of, you know, working with blockchains that are going to be coming around in the next decade. I can't remember the name of the project, but there was actually one crypto that had targeted what they called hard drive mining, where it was literally using free space on hard drives to hash blocks, and basically instead of using like GPU power, they were just using the empty space of the hard drive. So I mean, you know, 10 years in a tech like this is nothing. Like we are so obscenely early still that I mean, proof of work and proof of stake are our two kind of main methodologies now. But there's a chance that neither of those will even be the final.
Yeah, maybe it's a hybrid. Who knows?
Okay, we have a question right here. Right here.
No, I was just gonna say, I think there's a lot of misconception about financial derivatives, but instruments like futures and stuff like that allows people to share risks that otherwise would not be allowed to share. And these things exist from like a very long time. So like farmers can
Yeah.
hedge like the
future crops, which I understand. but
Yeah, no,
then-
but yours was an interesting question, like for different classes of assets, like,
Yeah.
but it would be hard.
It would be hard to get them to stop. And I mean, so can you, now one thing that's happening is the parent company of the New York Stock Exchange and the NASDAQ, ICE, created a third exchange called BAT, which is just for trading Bitcoin. Can you like explain a little bit about that and what you think that means for the market?
I think so. So BACT has recently opened up trading for physically settled future contracts of Bitcoin, whereas before all the other providers of derivatives was just paper. You didn't deliver the asset at maturity of the contract. I think that's a big change because now you have to physically deliver Bitcoin when the derivative contract actually expires. Over time, I think it's going to just allow more institutions to come into this space because big institutions want to hedge their risks. And the more liquidity, the more money is in the space, the more regulatory framework that they can maneuver in without knowing that they're going to be shut down by the SEC and whomever, the more likely they're going to invest their resources to develop. So I think overall it's a good thing for this space because you have the components of a healthy market. You look at stocks, bonds, any other market out there that is publicly traded, you have these mechanisms to hedge risks, to take positions on long, short, to have liquidity when you need it and have many counterparties interacting. So overall, I think is just a good thing. And it's a matter of time you will see more.
Yeah, fact is not bad because you do actually have to buy into the asset class in order to be able to make a bet on it. Now, the other form of futures trading, we did it, so that's where I saw a major problem, but fact is okay.
that was done because the banks didn't have to.
No, you're first, you can go ahead.
So, as you were saying about institutions kind of be coming in, no, they're already in. They're just not saying it. The banks have been buying. That's why they did the futures through the ICE futures back in 2017 because they weren't ready. They're doing the buying. You take a look at the walls, you see the transactions is being done. It's unethical.
Go ahead, Lewis.
Just wanted to add, I remember in 2015 there was a company, a pharmaceutical company called like Valiant or something. And there was a short seller, and she had so much inside information of the company. So she's like, this company's gonna crash because it just keeps buying other companies, not really creating like a product or doing anything. And that company was actually backed by Bill Ackman, and she was going against him. And she actually ended up becoming like super rich because she just was betting that the company was gonna crash. So that's kind of short selling, like you go against them. Like, what do you predict basically what the price is gonna be in the future?
Yes.
Yeah.
Financial advisor.
and then it's a fine line in those situations because, that could be insider trading if she works at the company. You have a question?
Yeah, I was gonna say, do you have any concern, with FX, Forex in 2000, America brought on such ridiculous regulations that they essentially regulated, like, the majority of the market overseas. They basically pushed everyone in the U.S. out. Do you have any concern with the U.S. getting caught in that same kind of thing again? We're already seeing Poloniex has dropped us, Binance has dropped us, multiple exchanges are starting to say they don't even want to bother with the U.S. because they're so fed up with the way that we deal with regulations. Do you have some concern that we may miss the bus as China, Taiwan, they're all jumping on and saying they're nationally endorsing it? Do you have any concern we're going to get left in the dust with that?
I don't think the U.S. will miss the bus, but it may end up being a few stops behind because of that. If you start reading the news that are coming out of saying, China now looking very seriously in developing their own digital currency. You gotta think about, they've already have something in place and they've been looking into it for a while. And when it comes from a country that has the ability to make decisions unilaterally without the challenges and lack of decision making that sometimes we have in the US, then they're going to be able to act and deliver very fast. So if they put their mind into it, they have the manpower and the resources to make it work.
Less with the fact that America will just get totally left in the dust in the sense that we're going to miss the boat, but more so that we're going to take so long to get things in order that the majority of the people that are out there running these exchanges, running these projects, are just going to drop the U.S. because they're saying, we don't want to deal with it, we're not going to wait.
Time will tell, but I don't think that will be that drastic. You're already seeing surveys that are published on the best places to do business. The U.S. is not the top one. Singapore or some Southeast Asian countries, but people still want to come to the U.S. to invest and to live, and capital is here. So I don't think that's that drastic. Whether we get a slower start because of not having clarity in the regulatory environment, yeah, possibly.
So I have a question from online. It says that there are a lot of predictions, like John McAfee and Tim Draper, saying, I don't know what exactly. Does anybody remember McAfee's exact prediction?
$2 million.
by
No, he doubled it.
2022.
He said $2 million.
Yeah, or else what?
2021.
All right, I won't bring that up. But I have someone here who says 2021 Bitcoin price prediction at 100K. Do you think that's possible?
100K?
At 2021. And here's the thing. You have your disclaimer up, right? It's up there.
It was.
So what do you think personally? Do you think, what is your price prediction on Bitcoin? Not that it matters, but what is your
I have none. But I'll tell you this, because here's what happens. If you would have asked people, it's like the article I showed up, 2016, before the other halving event. You asked 10 different experts they work in blockchain-based companies or exchanges, and they'll give you very wild predictions. And then you have this super high run-up from, it's just crazy. So I truly believe it can go to 100 the same way 2 years later it could go down to 15,000. I stick to what is your fundamental reason for investing and owning it, and if it's long term because you truly believe in the use case of it or what it represents and the value of it, then you may not care so much about the immediate price ramifications. Over time will tell. But if it's truly what you believe in, then probably it's gonna go on the high side. But how high? I don't know.
My biggest concern is, I don't know, what's your opinion on this? If the dollar keeps losing its value because they keep doing this quantity easing, well, now they call it retail, and they keep pressing that button. Now it's 130 billion every night, and they keep pressing, So now, what's your opinion about it if the dollar keeps losing value?
what's interesting about what you just said is that the dollar against other currencies is actually been appreciating. You got to think about what the alternatives are. What appreciating against what? So when you look at the rest of the world and you see that all developed economies are kind of in the same boat of a lot of debt and central bank easing and all that, then the dollar might be the most, the better structured reserve currency for now. Whether you believe that's going to stay and what is being done, it's prudent and all that, that's a whole different conversation. But, how that interplays with Bitcoin as a potential reserve currency and all that, I see a lot of the hedge fund based that are putting out material about macro dynamics and Bitcoin. I find that interesting, but using Bitcoin as a reserve currency, that means a lot of millions and millions of people need to get educated into this, and we're just touching the surface.
Okay, one more question, guys. Okay, cool, then I have the last question. So,
That's the most difficult.
if you, say that we're a client and we come to you and we don't have any Bitcoin, and I was to say, okay, I heard about this cool thing, I like it, I watched a couple YouTube videos. What percentage of their portfolio would you recommend a person to invest?
So right now, we are not giving recommendations on having Bitcoin or digital assets in portfolios. So that's number one. But what I just showed there, it's a very good framework. It's thinking about it as, here's your risky asset or a risky investment is going to be a small percentage of your investment portfolio. It's going to be a percentage that if it drops 80% overnight, you're going to sleep at night. You're not going to be worrying about, I need this money, I depend on it. And if you look at, when you look at it, all the number crunching, it's actually from a risk reward perspective. As long as it continues to have the price appreciation, it could be an asymmetric bet in the sense that you have a very small percentage of it. So if you lose 1%, 2% of your portfolio, 3%, is not devastating. But hey, if that 3% actually goes 10x or 100x, it could add something meaningful to your portfolio. So, I think that's a good framework to think about it. What's right, it depends on how risky you want to get and how strong of a believer you are in the space, and everybody will have their opinion,